Hey, everybody. I know I have 30 minutes to go over our slides. I have 85 slides, which means I'm only going to cover just a fraction of the slides. But let me tell you what I'm going to cover. So I've got 4 topics. One is I want to talk to you about why I think the crypto winter is over. And it's important. It's not important just for the people at this conference, but it's really important because this next wave of adoption for crypto is really coming from the mainstream and financial institutions. And so you have to think about how the crypto winter is over through their lens. The second thing I want to talk about, is we have to define FOMO. When do we think, at what level does this next wave of adoption come? And I'll give you some analysis we've done, but we think there's a certain price level of FOMO. And if indeed we're correct, there's also some historical context for how Bitcoin would act once this FOMO kicks in. And it's actually good news. The third thing I want to talk about is the usefulness of Bitcoin. I think you guys all think it's useful, but I want to really explain how Bitcoin's usefulness is really important for the broader decentralization of finance. And then finally, if I have time, I want to talk about demographics and how important millennials are. But the reason this is actually important is, despite what people think, I think the crypto community is a lot smaller than people realize. I think people talk about 50 million holders of crypto. I think it's a lot less. I think there's only 500,000 people that actually own Bitcoin. So I think that there is actually a much bigger wave of adoption coming, and I think it's going to be driven by millennials. So let's dive into that. And so the first slide to start with is the crash of Bitcoin. And not everybody here may be a Bitcoin bull. You might have your own coins that you're more interested in or your own projects. But let's just be realistic. There is no recovery in the crypto market until Bitcoin achieves its all-time high. This chart is burned into people's minds because that's Bitcoin at 20,000, down 85%. The mainstream media basically thinks Bitcoin died with this chart. And they kind of have some good reason to believe that, because since 1975, there have been 45,000 stocks that have traded on one of 3 exchanges, okay? NASDAQ, Amex, NYSE, of which 45% fell 90% from their all-time highs. That means, basically, if you look at the stock market over the last 50 years, half of the stocks end up down 90%. And, in fact, the average stock goes to 0 of that list. So the question is, if something's down 90% from its high, how many of these recover back to their all-time highs? Only 21%, okay? So that means if you're down 90% from your highs, you only have a 1 in 5 chance of recovery. And number one, that's why mainstream media thinks Bitcoin died, because it fell 90% from its highs, and most people think things like this never recover. But of course, we know differently, because Bitcoin has recovered from a 90% decline 4 times already. Okay. Now, at the start of this year, you can't really see this chart, but we sort of posted a little graphic here saying that a lot of the things that caused Bitcoin to collapse in 2018 were actually going to become tailwinds this year. It's things like dollar, macro, technicals, on-chain volume, et cetera. And I think as we're getting to the midpoint of 2019, I think a lot of this has come to fruition. So I think we have posted this before. We think there's 13 signs that the crypto winter is indeed over. And the first point on here, by the way, is a surprise. It's that I think the first sign crypto winter was over was the fork war, because that was when miners really fired their last meaningful shot in terms of controlling these blockchains. I think Jihan and Craig did a lot of damage to crypto technically from a price perspective, but it also, I think, is the start of the end of the centralization of mining. But something more important happened among this list, and there's a whole sequential list here. You can see it when you go to copy. I think the most important thing that happened this year was that Bitcoin crossed above its 200-day moving average. Why does that matter? Well, this chart sort of shows this. If you look at Bitcoin's price over the last 10 years, whenever it's been above its 200-day moving average, its average 6-month gain is 200%, and it's up 80% of the time. When it's below its 200-day moving average, Bitcoin has 1/10 the forward return. So the biggest thing that happened this year, I know it sounds overly simple, is that Bitcoin actually crossed above its 200-day moving average. And of course, why does that matter? Well, this dark red line is the Bitcoin 200-week moving average, and then you see the 200-day. Every time you've crossed above its 200-day moving average, it's the start of a new bull market. So I do think that what you have to keep in mind is Bitcoin's old high is not going to be the limit of where Bitcoin trades to. So let's talk about another reason why we think the crypto winter's over, which is the Bitcoin Misery Index. It's something that we publish at Fundstrat. It's a measure of what we perceive to be the sentiment of a holder of Bitcoin. And notice the red line there. That's 67. Bitcoin crossed above 67 in April of this year on the BMI index. And why does that matter? Well, I've highlighted in red dots every reading above 67. And here's something interesting. Bitcoin has never posted a 67 reading in a bear market. It only occurs in bull markets. So again, the fact that the BMI is above 67 means very likely crypto winter's over. And of course, macros turn. This is emerging market stocks in the red line, and Bitcoin in the blue. You can see since in the last 3 years, they're pretty much the same chart. EM stocks are doing well. This chart is the dollar. It's another macro factor. The dollar has been kind of weak this year. And as you can see, dollar and Bitcoin really trade inversely together. So let's say crypto winter's over. But what is the key level here to drive FOMO? Now, I think people think FOMO is a bad thing. I actually think it's a good thing because FOMO is what allows people to have confidence in actually buying an asset. And so we did a little Twitter poll, and we asked people, what level they think is FOMO, and the crowd said 10,000. That was the central voting. And it turns out I think that's actually the right number. I think 10,000 is the right level for Bitcoin's FOMO to kick in. And what it really represents, and it's kind of hard to see in this chart, is that if Bitcoin gets to 10,000, it's a price level that it's only seen 3% of its days in its history. So in other words, FOMO doesn't kick in when Bitcoin goes to an all-time high. It kicks in when it gets to a price that people don't think it could reattain. Now, what does 10,000 represent? As I said, it's 3% of the days. You can see there's only a handful of days where Bitcoin was above 10,000. But 10,000 for Bitcoin today is similar to Bitcoin trading above 4,500 and retracing in 2017. So again, it's a level that's not necessarily early in crypto, but it's also not the peak. And again, if people bought Bitcoin at 4,500, they were pretty happy. The reason for that is this chart. What we did on this chart, and it's a little messed up, the red line represents every price level above the 3% FOMO. And what you see here is that if you were to set 3% as the threshold and say, once Bitcoin gets to that level, what does the price path look like afterwards? You can see that you have somewhere between a 200 and 400% gain over the next 5 months. What it tells us that is if Bitcoin gets back to 10,000, it's very likely going to make a big move to 40,000 within 5 months. And I won't say that that's necessarily the peak, but I think it's going to show you the kind of explosive price dynamic that's at work if Bitcoin does get back to 10,000. And it's something that we think is very likely. Another reason you should expect FOMO to start developing is what's happening with the grayscale ETNs. It's the premiums, and you can see on the GBTC, which is the Bitcoin premium, it's actually starting to surge. And the one on the right is for their Ethereum Classic, and that premium now is 270%. A big catalyst for this, of course, is the halvening that's coming in May, and everyone's obviously aware of this, but it's a huge deal, right? I mean, Bitcoin supply is going to drop by half in May of next year. And there's another FOMO to think about, which is that in the stock market, the thing that everybody owns, the most widely owned trade is FANG. If you're not familiar with FANG, it's 4 stocks: Facebook, Amazon, Netflix, Google. And what we've done is show you the price ratio of the two. When the line is falling, FANG is crushing Bitcoin. And when the line's rising, Bitcoin is crushing FANG. So you get FANG FOMO, or Bitcoin FOMO from FANG, whenever this line's rising. So as you can see, in 2018, FANG was absolutely crushing Bitcoin. That's why the line collapsed. And nobody felt like they had to own Bitcoin, they just had to be long FANG. But look at this year. FANG is doing badly, and Bitcoin's rising. This is creating the type of FOMO you want to see, that if you're an institution and you can do a CME trade on Bitcoin, and FANG is doing badly, and by the way, FANG is available as a futures trade, you're going to be going long Bitcoin and shorting FANG. And that's the type of FOMO we want to see. All right, so let's say that's covering our thoughts on FOMO. I want to talk about why digital assets are useful, okay? And I want to start with this slide. So this slide is showing you what I think are the 4 reasons cryptocurrencies and blockchain are essentially going to decentralize financial services. So the first point is that the blockchain and crypto really replaces trust from the traditional financial system. So if you want to say, how does cryptocurrencies capture value, or how are you going to make money, it's really any entity that can act as that intermediary that replaces trust in financial systems. And an example of this, for instance, is, I don't know if you guys saw the Block article this week about MoneyGram CEO, but he talked about how he thinks digital currencies and digital assets are going to become the primary pair to do remittances overseas. It makes a lot of sense, because today any money transmitter has to have banking on both sides and tie up a lot of working capital, and they stand in on trust. How much easier is it to just send Bitcoin overseas? The second is productivity, that as you replace these former legacy centers of trust, you're also replacing a workforce. 40% of the cost of any banking system is the compensation paid to employees, so there's a lot of money saved. It also means that companies like JP Morgan could have 90% fewer employees in the future and still make the same money. The third is that working capital will get optimized. I don't think most people realize this, but today about 14% of all global GDP is tied up as cash. So companies, on average, have to keep about $11 trillion of cash just to be in business. That's a huge amount of productivity wasted. And of course, store value. Now, why do we think there's a problem with the financial system? I think the easiest way to see this is to think about how much money banks make today. So the chart on the left is interest rates since 1970, and you can see they've gone from 16% in the US down to 2%. Yet, despite the fall in interest rates, the chart on the right shows you by country banking profits as a percentage of GDP. And they've actually doubled since 1970. So think about that. Interest rates are down. They're negative in 21% of countries right now. Yet banks are making more money today than they did 50 years ago. And this is despite technology making the cost of financial services cheaper. Well, how much does this actually cost? This is where you need to take a step back. Today, banking captures 6% of GDP. Okay, that means that the average person who has a bank account spends 3.5 weeks a month for the right to use the banking system. I mean, that's a huge tax. Like 1 month a year you're spending paying for the banks. You're spending 2 months a year paying the tax person. That's more than anyone takes in vacation anyways in a year. And to put this in perspective, Facebook, which I think is probably the one company that knows more about you than any other company, only generates about $7 of ARPU per year from their average user. The bank generates close to $1,000 a year per customer, and they know very little about you. So if you had to wonder why Facebook and technology companies want to get into finance, it's because it's a chance to grow their revenues by almost 100x. And of course, you can see how concentrated banking is today. 5 banks in the US control half of all assets. Outside the US, it's even more concentrated. Typically, the top 3 banks control 75% of assets. And another thing to keep in mind is that we're starting to see global GDP growth increasingly native digital. Now, what do I mean by that? Let's just say that financial services, technology, and healthcare are primarily native digital services, and that's mostly true. From 1980 to 2000, they represented roughly 25% of all incremental global GDP growth. In the last 20 years, native digital accounted for 50% of all global GDP growth. And in the next 20 years, of course, we think that this ratio is going to grow. So if the next 20 years, 3/4 of all growth in the world is native digital, why do we have locally based denominated currencies? I think there's going to be an interest in global currencies with a lot less friction. Okay, so let's get back to this third topic, which is demographics. Okay, so I think one of our central themes when we talk about crypto is the idea that really Bitcoin and crypto is a lot about millennials. Just like we talk about how we think everyone should have 2% allocated to crypto, and I think that's really an important way to think of it. But why do demographics matter? Well, before you think I'm going to bore you to death, demographics explains markets better than almost anything else in the world. In fact, I can tell you that if you just use demographics solely, you could predict stock market tops since 1870 with a 40-year lead time, and you'd be right within 1 year every time. So what do I mean by that? Well, these are the 6 living generations in the United States. Greatest generation, silent generation, baby boomers, Gen X, millennials, and Gen Z. Most people in this room and most people who do crypto are millennials. On the right side, I list the year that the total population of each generation peaked. It's not the same as births because there's immigration, and it's not exactly 20 years apart because there's wars and everything. But take note of the dates: 1930, 74, 99, 2018. Well, see, take a look at this chart. This is the stock market since 1870, and I marked with columns the peak of every generation. It's called every major market top. So think about that. You could have predicted every major top, every major crash with a 40-year lead time, just using births. And interestingly, we published this last summer. 2018 was the peak of Generation X. Well, what happened in 2018? 97% of global stock markets around the world had a negative return, the worst since 1900. So last year, even though the US only fell 20%, it was essentially a global crash last year. Now, here's what's good. The good news, if you guys own equities, if our analysis is correct, the next major bear market's not till 2038. So, we're in a bull market for stocks for 20 more years. Okay, well, let's talk about what each generation cares about. And the reason I want to talk about this is, one, every generation adopts either an asset class or a type of stock, and that's the opportunity. There's some very specific things that I think are happening with millennials, but again, I think the key point here is Bitcoin's not as widely held as people think. So, with boomers, a lot of the revolution they saw was, PC to mainframe, women entering the workforce, mail order business. Generation X, it was the cellular generation and internet. And millennials are essentially the digital generation. Okay, well, what does each generation do? I'll give an example. The bottom lines show the number of people in each generation aged 35 to 60. Those are the prime income years. And that dark red hump is the silent generation. Who was the silent generation? These were kids born during the Great Depression. Okay, so they're the their parents got wiped out from the stock market crash. They coincidentally entered their prime income years at a time when they could buy gold for the first time in the US, and the dollar no longer was linked to gold. And as you can see, during that period of time, gold had its only 15x run in history. So in 8 years, gold had a 15x run because the silent generation decided they didn't like stocks, they wanted to buy gold. The boomers, which is the light blue line, entered the prime income years starting in 1982, all the way to 99, and what did we see? We saw a massive, massive equity boom. And let's talk about millennials. Remember, this is the biggest generation in the US history. There's 2.5 billion millennials globally, and they're already making a big difference in certain markets. I'll give you an example. This is recreational vehicle sales. I'm not sure if everyone knows what an RV is, but it's that camper right there. It's called, some people call them motorhomes. Last year, motorhome sales were the highest since Lucille Ball was on TV, so the highest in over 60 years. And as you can see, 44% of the buyers of campers are millennials. Millennials have completely revived the RV market. And in fact, they're buying so many of these motorhomes that it's actually causing gasoline consumption to actually rise in the US. Okay, well, that's what millennials are doing. Let me jump back to the boomers. I showed you boomers buying stocks as an asset class, but that's not the real trade. The real trade for the boomers started in 1980. This chart shows you consumer spending as a percentage of GDP, and as you can see, because the parents of boomers were frugal, consumer spending as a percentage of GDP actually fell to a multi-decade low, beginning in the 1980s. And then the boomers entered their prime income years, and you actually saw a tripling of consumer spending over a 20-year period, the largest gain of consumer spending in history. Well, what did that do for stocks? Turns out that consumer stocks were monsters. So even though there was an equity boom, there was an even bigger boom in consumer stocks. The top 7 best performing consumer stocks turned $1,000 into 1.2 million, okay? What does that mean? Let's just say you were a terrible stock picker and you bought 100 consumer stocks in 1982. You could have been so bad that 93% of your picks would go to zero, and on average, only 50% do. And you'd still have a 12x return. You would have crushed the S&P just by buying consumer stocks and being a bad stock picker. Similarly, internet was the same trade. So Gen X was 26.5 in 1997. Boomers were 26.5 in 1980. And if you bought 100 internet stocks in 1997, 96% would have gone to zero, but you still had a 16x return, and you would have beat the S&P 500. So again, the point is, if you get the demographic trade right, you can be a terrible stock picker. And again, in crypto, I think Bitcoin's the way to go, but if you were to buy a basket of crypto, this is the same trade that we think is being set up. And this is the opportunity. Now, if you look at sort of widely published estimates, people think that there's roughly 50 million crypto wallets out there. And Visa, MasterCard have roughly 4.5 billion. So it's about a 100x opportunity if crypto starts to see the adoption levels of credit cards. And using network value drivers, 100x in the adoption rate of crypto would be a 10,000x in the price of cryptocurrencies. So if this chart plays out, Bitcoin's over $1 million, right? But I'll tell you, I actually think crypto's a lot smaller. See, on the right side, we said that maybe that crypto's really a 1.9 million user market. I even think that's generous. I think there's actually only 500,000 people in the world that own crypto. And I'm not trying to make a negative statement, but I'll just give you some things to think about. One way to measure this is look at crypto Twitter as an example, right? So you guys, I'm sure everyone here uses Twitter. And you can say that a huge number of followers on crypto Twitter is 100,000 users, right? So someone who has 100,000 followers probably has a lot of influence. And 1 million is rare. I mean, I think there's only 1 or 2 people in Twitter, crypto Twitter, that have 1 million followers. If you look at Major League Baseball, I think the 100th player on an MLB has 1 million Twitter followers. Take a look at Instagram. 1 million followers is nothing. Or look at global soccer. I think like the 500th most popular player has 1 million followers. I think crypto, Twitter, tells us how small the crypto market really is. And that's really bullish, because if Bitcoin is at $8,000 with 500,000 followers, imagine where Bitcoin's price is going to be if you have 4.5 billion users. This is incidentally another reason to argue against Bitcoin ETF at the moment. But before I get into that, what do we know about millennials? First of all, 92% of millennials don't trust banks. So I already showed you how banks make too much money. It's overly centralized. But now we know that millennials don't like banks because their parents or one of their relatives got destroyed from the financial crisis. First Data did a survey. 71% of millennials would rather go to the dentist than listen to what banks have to say. And 33% believe that they won't even need a bank in 5 years. And incidentally, the same survey shows that they think millennials are going to inherit about $7 trillion over the next decade, in the next 5 years. So how much money will they put into crypto? I don't know. I mean, if they put 10% in, that's $700 billion. It's a ridiculous amount of money to go into crypto. And so let me sort of just pause here for a moment, because there's a lot of interest in Bitcoin as an asset class. In fact, we can see it here. I'll just show you some charts. I think probably the most interesting thing is that we're starting to see a lot of things that look like plumbing going into crypto, from JP Morgan announcing their stablecoin, pensions investing in crypto, the backed launch, and the CFA Institute is adding crypto to its curriculum. And I don't know if you guys know what the CFA is. It's really the governing body in the U.S., a semi-quasi-regulatory body that regulates who can study financial markets and is certified. It's a big deal they're adding crypto to their curriculum. But the one thing that people don't realize is that if you just put 1% or 2% of your allocation into crypto and you were to rebalance it every year, you get a huge boost in total return. So you guys have seen this chart. I'm going to skip it, and plus I'm running out of time. And it's really important. We've said this before. I'm not a big believer in trying to be a timer of markets because of this chart. This is the top 10 days, okay? So if you look at every year since 2013, the light blue line represents the return of Bitcoin on their 10 best days. And the dark blue line is the return of Bitcoin the other 355 days. If you didn't own Bitcoin for their 10 best days in any year, you lost 25% a year. So think about that. Bitcoin makes all of its returns in just 10 days. Okay. So in my final minutes, because I have 2 minutes left, I want to tell you why I think the Bitcoin ETF is a positive, okay, unequivocally positive, but I just don't think it's going to happen in the next few years. Number one, as you guys all know, there's a huge regulatory hurdle that the SEC is institutionally somewhat hostile to crypto. Part of it has to do with the lack of transparency in pricing, and the previous speaker really did a good job of explaining the issues with volume and reporting and the gaming of pricing. But I think there's a secondary issue. The Bitcoin ETF might be too much of a good thing. Okay? If you look at the top 10 ETF launches, even the top 20 ETF launches, the average is $1 billion of demand in the first year. Okay? That's $20 million a week. With the halvening taking place next year, Bitcoin's daily supply is going to be $5 million. that means that if the ETF were to launch for Bitcoin, you're talking about $20 million a week of demand, almost $5 million a day, which would buy every single block reward that a miner receives. Think about that for a moment. If Bitcoin has equilibrium today, and then you get a new entity that's buying every single block that's coming from a miner, what do you guys think will happen to the price of Bitcoin? Look, it's game theory. Every miner is going to withdraw supply. Everybody who holds Bitcoin isn't going to sell it, and you've got $5–6 million a day of ETF demand. I think there's a chance that Bitcoin's price has a massive parabolic move because of an ETF. So I think that Bitcoin's price and the market needs to get a lot larger before we have an ETF. Otherwise, Bitcoin's price would potentially go ballistic on an ETF. So with that, I'm going to finish up, but I want to thank you guys for listening, and there's a copy of slides available, so for everyone who's attended this conference, just let the organizers know, and you can get a copy of the slides. Thank you.